Fixed income is 12% of the exam, and so in a 3-hour paper you're looking at approximately 14 questions, and again that applies morning and afternoon. So at a 12% exam weighting, it's quite a sizable section, quite an important, quite a technical area. The idea of this videocast is to give you an idea about what kind of information you're expected to understand, and really just act as a bit of an introduction so that you can further progress in your studies in this fixed income section. Basic features of bonds. We have different types of issuers of bonds who are ultimately all wishing to raise capital. They're basically borrowing. Main issuer types include corporates, so typically large companies, sovereign governments, which implies they can raise tax, non-sovereign governments. This might be, for example, a local authority. So in the United States, possibly cities or states or counties might issue bonds to raise money. Quasi-governmental organisations, sometimes these are domestic agencies in a certain country, possibly supranational organisations, agencies such as the IMF, the World Bank, the European Bank for Reconstruction and Development. The maturity of a bond is often quite important and often part of the way of describing the bond. So for example, a UK company, Tesco, might issue a 2024 bond. In reality, it will redeem and mature on a very specific date in that year. It might, for example, be the 19th of April, but often people just make reference to the year in which it redeems. Some bonds never redeem. They are perpetual, also known as irredeemable or undated bonds. A good example here is the 3.5% war loan, which was issued by the UK government originally in 1917 to finance the First World War. It has no set date on it, hence it's irredeemable. It's expected to carry on in perpetuity, forever. The par value is also known as the nominal value, the face value, and might also be described as the redemption value of the bond. Usually, bonds will also make a reference in their name, their title, to a coupon rate. This is usually an annual percentage of the par value. Exactly the frequency of the payment, it could be annual when all of the coupon is paid at once. So it might be, for example, that you own a 6% coupon bond, and let's conveniently assume you happen to own exactly $100, in which case your annual coupon is $6. If it was semi-annual, the idea is it's split in two, and it might be that you receive $3 on the 7th of March, and then the other $3 on the 7th of September, approximately 6 months later. Some bonds have quarterly coupon frequencies. Some, particularly those associated with mortgages, so mortgage-backed securities, might pay a monthly coupon. Usually in the basic description of a bond as well, we get a feel for what the currency of the payments are. And usually that's all one currency. You can get so-called dual currency bonds, which might, for example, pay coupons in pounds sterling, but then pay the par value back on the redemption of the bond in US dollars or some other currency. Some bonds might also have a currency option, allowing the investor to choose in which currency they receive, perhaps, the par value back on redemption. It's quite common for bonds to have options embedded in the bond. And as a general rule, these options will either benefit the issuer, giving them choice and flexibility, or possibly benefit the investor, giving them flexibility or protection. One of the most common types here are callable bonds. The idea here is we have a call option which allows the issuer to buy the bond back early. So for example, a company might be issuing a 10-year bond, and we're expecting it to mature 10 years from now. In a regular bond, that would be the maturity date, and that's the end of the bond's life. But with a call option, it might well be that after 6 years since issue, the issuing company can actually buy the bond back. That would not be uncommon to have a deferred lockout or protection period. In my example, the bond cannot be called back for the first 6 years of its life. Exactly at what price the issuing company can buy it back we'd need to make reference here to the call terms. The call terms might stress what the strike price is, and indeed that might change over time. So it might be in 6 years' time, the issuer can buy the bond back at $102 per 100 par. And that might be the first call date. It might be that 2 years after that, so 8 years from now, the company can actually buy it back at par, if they wish to. If they didn't exercise their right to buy it back, we would assume that it will be redeemed as normal on the set maturity dates. Sometimes a make-whole provision is designed to basically protect investors. The main reason why companies will typically want a bond to be callable is so that they can take advantage of low interest rates. The idea is, should interest rates fall, they can refinance, i.e. raise more debt, but at a much lower up-to-date interest rate. Puttable bonds give the investor, the holder of the bond, the right to put it back to the issuer. And therefore, this is an option which protects and benefits the investor. The investor will exercise their put right if they wish to. This is in contrast to the call option, which was really to the benefit of the issuer. When people talk about option styles, there is jargon associated with them, and so options will often be described as European style or American style. This is just a general description with regards to options, trying to describe their feature. It's not necessarily where the option was traded, or perhaps in this instance, options embedded in bond, where the bond was issued. A European style option typically suggests it can only be exercised on one specific date, whereas American style option often suggests it can be exercised on any business date leading up to and including a specified date. A Bermudan style option is a third alternative. Bermuda, roughly, somewhere between America and Europe. Well, surprise, surprise, a Bermudan style option is somewhere between an American and a European style. With a Bermudan style option, you will have a few specified discrete dates when it can be exercised. Convertibles are another example of a bond with an embedded option in it. And this usually means the investor has the right to convert into a specified number of stocks, the so-called conversion ratio. So for example, a bond might allow you per $1,000 par to convert into 20 ordinary shares of the issuing company. Exactly what this conversion ratio is, once again exactly when you can exercise this, we need to know the exact details for this particular bond. The conversion price is the price per share at which the bond may be converted. It's effectively working out how much you are paying per stock if you were to convert now. Another way of looking at this is the conversion value. What's the value of the shares that would be received upon conversion? Again, assuming theoretically you were to convert now. Related but slightly different to this are warrants. It is quite common for bonds to be issued with warrants attached. A warrant gives you as the investor the right to buy new shares from the company at a certain price, on, possibly before, a certain date. And so a bond with a warrant attached is very, very similar to a convertible bond. They are both really examples of a bond with equity upside potential, assuming the share price does well. Slightly different from this is a CoCo. CoCos have started to become quite common, issued by banks often. They are a contingent, convertible, hence CoCo, bond. Usually with a convertible, if the share price does well, as the investor you would convert and you would benefit from the upside. This is slightly different. With a contingent convertible bond, you as the investor do not have the right to convert, but rather, should certain financial ratios of the issuing bank look weak, and often this makes a reference back to the core and equity ratios as defined in Basel III, if those ratios look weak, certain triggers might mean that your bond has just converted into equity. So rather than the regular convertible, when you choose to convert if the share price is doing well and the issuing company is doing well, This works in the opposite direction. If the company is in trouble, your bond has just converted, whether you like it or not, into equity. Different types of corporate debt can include, well, most obviously, bank debt. Often companies approach a bank if they need capital, they need funding. Probably the big difference between bank debt and tradable, sometimes known as negotiable debt, is that bank debt will often be charged interest at a variable rate, quite often linked to the London Interbank Offered Rate, or LIBOR. Bank loans might be bilateral. It might be, for example, just a simple loan between company and bank. If it's a much larger piece of funding, we might have a syndicate of banks who collectively advance lender monies. CP is commercial paper. This is short-term, unsecured, negotiable, i.e. tradable instruments. It's basically a short-term, usually weeks or months when it's first issued, zero coupon, hence discounted security. Often companies will frequently issue these, effectively rolling over their finance. This is sometimes used as bridge finance, i.e. the company is using it just to bridge a short length of time before they perhaps raise more long-term funding, such as corporate bonds. One other type of a serial bond is where the bond dates vary over time. Serial maturity bonds basically mean that a company is gradually paying down its debt. MTN stands for medium-term notes. This is not necessarily actually suggesting that they have a medium length of time until they are redeemed, but rather an MTN program, a medium-term note program, is where a company just continually offers certain types of bond. And if an investor such as a fund manager is interested in getting more of those bonds, they can usually get in touch with the company or their agent. Repos are short for sale and repurchase agreements. They are effectively a form of collateralized borrowing. So if, for example, as an investment manager who holds bonds, you wish to borrow money, the idea is you can effectively sell some of your bonds in order to raise cash. Because there is a linked second leg to repurchase the bonds, you will basically buy them back later at the amount borrowed plus interest. This really just becomes, after the repurchase, borrowing that is now repaid. Hence a repo, although it technically is a sale and linked repurchase agreement, it really is just a way of borrowing, providing bonds as the collateral to keep the interest rate low. And this rate would be known as the repo rate. Bonds are the most common collateral in a repo. Quite an important area at level 1 is calculating the value of a bond. And it's basically a present value calculation. The value of the bond is calculated by looking at the future cash flows of the bond and working out today's present value. We discount them back to a PV. And as I'm sure you're aware, to calculate the PV, we need to know, number 1, the amounts and timings of the cash flows we're expected to receive, and number 2, a discount rate, a risk-adjusted discount rate. If you see more risk in investment, you use a higher discount rate. With bonds, we often know what the cash flows are going to be because the issuer promises to pay certain amounts on certain dates. And so it's perhaps easier with a bond to do this discounting calculation than perhaps it is with an equity, where we're often expecting to receive dividends which are not promised, which are not often a fixed amount. Here's an illustration then of bond pricing. Let's imagine that we're looking at $1,000 face value of a bond that has an annual coupon of 6.75%. I've just stressed annual coupon here to suggest that it's actually just paid once a year. Now, to keep this simple, let's just imagine this is a 2-year bond. It only has exactly 2 years remaining until its final maturity. And we're going to discount this at a rate of 4.25% per year. So on a timeline, here's the cash flows. We've got in 1 year, $67.50. That's $1,000 of face or par value times 6.75%. Another year after that, we'll get another coupon, also of $67.50. And because this is the maturity date, we're also expecting the $1,000 par at exactly the same time. And we want to discount these cash flows back. How do we discount cash flows back? Well, we divide by 1 plus the discount rate we're using to the power n, where n is the number of years we're waiting for this cash flow. So in this instance, $67.50, which arrives in a year, let's divide that by 1.0425. We're only waiting 1 year, so we're dividing by 1.0425 to the power 1. We might as well combine the second cash flows that arrive in 2 years' time, $1,067.50. Final coupon and par being received at exactly the same time. And we're going to discount that back by dividing it by 1.0425 squared. Hence the present values of these two cash flows respectively are $64.75 and $982.23. Add them together, that's the present value of those cash flows. And that's the value of the bond. What we'd expect to pay for this bond, $1,046.98. We could work through some other examples. For example, what is the price of a 5-year 8% bond? If we discount this at an interest rate or yield or discount rate, we could use all of those phrases interchangeably. What about if we discount them at 6%? Let's work it out again at 8%. And let's work it out again at 10%. And so I could use here my Texas calculator. And of course the idea is I'm going to pop in what the various cash flows are on this bond and ask the calculator to discount it back. So in this example, it's a 5-year bond, so 5 is N. I will do it here per 100 par, so $100 or £100 par. It doesn't actually make much difference, but 8 is going to be my payment or PMT. 100 is going to be the future value, the par value that we get, the bullet that comes back at the end of its life. And I'm first of all interested in discounting it at 6%. So 6 is the I stroke Y. And I now compute the PV. And I should get an answer here of 108.42. If you had done it per 1,000 par, which is also common in the CFA Institute texts, you'd have simply got 1,084 spot 24. You'd have just got an answer 10 times bigger than the number I got when I worked it out per 100 par. The good thing here is, if ever I wish to recalculate the price at a different discount rate, I can simply put in my new discount rate and compute PV again. So for example here, if I change I stroke Y to 8, so 8 I stroke Y, compute PV, it just updates the new price. And the PV now is 100. And we should soon feel quite comfortable with the fact that if you discount a fixed income bond at the same rate as the stated coupon rate, the price is indeed par. This should also tell me that if I now increase the discount rate to 10%, 10 I stroke Y and compute PV, I will now get a price of less than par, specifically 92.42. Don't worry about the fact that the calculator will present the number as a negative. It effectively assumes that you are the payer of these cash flows, so if you like, the issuer of the bond rather than the investor receiving these cash flows. As long as we're happy that that is the correct absolute value, it doesn't matter whether it's a positive or a negative. So we should see that there is an inverse relationship, a rather well-known inverse relationship between rates and bond prices if they're fixed income bonds. Rates up, price down. Rates down, price up. So this price-yield relationship is often shown on a diagram where we have price on the vertical, yield going across the horizontal. So, in terms of this price-yield relationship, yes, it's inverse. Higher yield or discount rate means lower price as we go over to the right-hand side of this diagram. However, It is not a linear relationship. In fact, this is often described as a convex, curved relationship. The one thing to look out for at the CFA Level 1 exam is that quite often you'll be asked about US Treasury bonds or other bonds like UK government bonds, often known as gilts, which actually make semi-annual payments. And although the coupon rate is once again expressing the annual coupon that you'll receive, it is actually split in two. So for example, if I was to own $100 par of a 7-year 6% Treasury bond, really what that means is I'm not receiving $6 once a year, I'm really receiving $3 every 6 months. And that means really from a discounting perspective, I will have to tell my calculator that actually I've got 14 semi-annual periods remaining. So rather than 7 years, I will simply put in all of my cash flows, my discount rate, my payments, on a semi-annual assumption. So in this example here, I would be typing in that 14 is N for the 7-year bond. 3 is the payment on this 6% semi-annual pay bond. 100 will be the future value, but I will discount it back at half of the annualized yield at 8%. So I'll put 4 as my I stroke Y. And if I compute PV, it should once again logically tell me that I'm going to have a value of less than par because I've discounted it at a rate which is higher than the stated coupon rate. If I'm asked to change the yield now to 9%, well again, I am going to do it on a semi-annual basis, so 4.5 would be my I stroke Y, and I'll compute PV. Again, if the yield goes up, surely the price is coming down. Yes, that logically makes sense. I've got 84.67 as my new price. One thing that you might also be asked to do is to work out an annualized holding period return. I'm just going to briefly outline how this question would work. So an investor buys a 10-year 6% bond. Here it's stressing its annual pay, 1 coupon a year, and it's bought at a yield of 7%. We could work out that price. We're then told that they hold the bond for 2 years, reinvesting cash coupons at 4%. So presumably 1 year after they bought the bond, they receive a coupon. And that can be reinvested, earning interest at 4% a year. Presumably 1 year after that, so 2 years into the holding period, they also now receive another coupon. If they're actually selling the bond at that point in time, although we'll receive that coupon, we will not have had time to reinvest it as the investor. So there'll be no interest on interest here. Nevertheless, I can quite easily work out how much coupon I received